Okay, so topic 4 all about fundraising and finance. This is part 1 of the discussion. Okay, so our discussion will focus on how the organization or the company will be able to raise fund, either inviting investors or either issuing bonds or debentures. Okay, so which means they will ask for money using bonds or certificate, okay, and the bondholder or the investors will purchase those bonds or shares. Okay, so there will be two ways of generating funds. The first one is issuing debt capital. The second one is issuing equity capital. Okay, so when you issue debt capital, you are issuing certificate, and those person who purchase those debt capital or bonds or debenture will be will be able to collect interest from you or from your company. Okay, and at the redemption date, you will have to pay the whole amount or the principal amount. Okay, so when you issue equity capital, okay, so those who acquired equity such as ordinary shares and preference shares will be so-called owners of the company. Okay, so that's the second part of our discussion on rights and responsibilities, okay, of shareholders. Now, when it comes to debt capital, as I mentioned to you, you will pay interest. There, most likely, it will include fixed rate. Okay, most of the time fixed rate. But in other discussions, they will have variable rate. Okay, so I will not discuss that one. There will be a discount rate, stated or nominal rate, effective rate. Okay, but there will be such things. Okay, as discussed in accounting. Now, while equity holders will receive dividends. Okay, now as we know, dividends is not automatically payable, not unless it is declared. Okay, so which means, as per accounting, you're not supposed to recognize liability. So only when the board of directors have declared dividends, then the dividends will be payable. So there are chances that the company may not declare dividends within a year. That discussion I will reserve on dividends discussion. Alright, so debenture holders, there will be certain number of years that they will hold the bonds or debenture, and then after that, the company has to redeem. We call it redemption of bond. Okay, so at that time, you will pay the principal amount. Okay, so you receive money, let us say last year, and you want to redeem it this year, you will have to pay the whole amount. Okay, including of course the accrued interest. And then shareholders have no rights to return of their capital, although the returns of capital are possible during the life of the company and on winding up if the company is solvent. Now, unlike with the bond or debenture holders, in maturity they are required to receive, or they are privileged to receive the full amount of the bonds that they purchase. But for shareholders, it's not possible. So which means you put your money, company will run the business. Whatever the business earns, they will give it to you. Okay? So you are not expected that you will get the exact amount that you invested. Okay? So because again you're considered as an owner, so you have to bear the risk, and of course you will be able to reap the benefits. Okay? Now, what's the advantage of or disadvantage of debenture holder and shareholder? Okay, so if the company paid interest, okay, interest is considered as expense. So meaning in taxation that will be deductible. Okay, so when it is a deductible, it will affect the income tax that the company will pay. It will decrease the income tax that they will pay. But for dividends, if the company declared dividends, then that dividend is not part of the allowable deduction. So which means it's not, what you call this, it will not be able to reduce your tax liability. Okay? Now, of course, in decision making, because we're talking about fundraising and finance, some companies will prefer to issue bonds. Okay? Why they want to issue bonds? Because bonds, the interest that they will pay will be deductible. Got it, huh? But at the same time, if they are having bonds, or they issued bonds and then they have to pay interest, it's automatic, right? So meaning every certain period, they will pay bonds. Sorry, they will pay interest. So that's a disadvantage of having bonds. While for dividends, if the company paid dividends, it's not taxable. Sorry, it's not allowable deduction. But at the same time, it is only payable when declared. So which means financially or cash flow wise, it's actually much advantageous for a company to invite shareholders or investors to purchase shares. Okay? So as future managers and entrepreneurs or board members, you have to think about this. Is it okay for me to issue bonds, or is it right for me to issue shares? Okay? Now that's a quick thinking, not quick thinking, but that's a huge thinking that will be vested to the one running the business, which is the board of directors and senior management. Okay? So that's one thing that I want to emphasize on the taxation part. Now, membership and control. Okay? Now, debenture holders and other lenders are creditors and external to the company, which means if they are external to the company, they don't have the privilege of running the business, and then they don't have the privilege of dictating what the company should do. Okay? Because they are external parties, they are not expected to be part of the management. Although in certain instances, the bondholders may elect someone just to oversee what's happening with their interests. Okay, that's another part. We will discuss it in liquidation. Okay, and then for the shareholders, it's obvious. If you are a shareholder, and as I mentioned a while ago, you're an owner, which means you at least you have a say on how to run the business. Okay, whether you only have one share or 1,000 shares, you're holding 1,000 shares, okay, still you have certain voice, okay, when it comes to decision making of the company. But again, as we discussed, we will discuss in governance, what we will do is, because we have plenty shareholders, we are putting our oversight power to what we call board of directors. So group of people who will oversee what's happening with the business. Okay. Another thing, of course, if you are an owner, when it comes to annual general meeting, again, even if you are only having one share, you still have a voice there. And you can actually ask question, okay, in AGM. Alright, so we'll just go through some definitions. Okay, when we talk about securities, okay, for the purposes of fundraising, securities are shares, debentures, legal or equitable interest in the shares or debentures, or options to acquire shares or debentures. Now, it actually talks about options. Okay? When you say options, you have a certain privilege on purchasing share on a certain price. Okay? So, when we talk about option or share options, we're talking also about option price. Okay? Now, decision making, if the option price is lower than the market price, you will exercise your option because you will pay less, right? If you are an investor. Now, if option price is greater than the market price of the share, you don't exercise your option, okay? Or else you're just giving money, okay? So that's a part of the decision making. Now, again, when you talk about securities, it includes debentures. Okay, so when I say securities, from now on, I'm pertaining most likely for both shares and debenture. Okay. Now the other term is security. Okay, this is different. Okay. When you say securities, again, those are shares and bonds. Okay. Security can simply be an individual investment instrument or a right against debtor's property given to a lender to secure the repayment of loans. So when we plainly say security, it is either investment or the right of the bondholder over the property. Okay? So that's for the definition for securities and security. Another one for definition. Okay, we have debentures. So that is essentially debt security or securities. Derivatives, type of financial instrument that involves a payment in the future with the calculation of payment based on reference benchmark, such as asset and an interest or exchange rate, a commodity price, or a value of an index. Simply stating, if you are studying accounting, you may have encountered this. Derivatives are used to sort of help to reduce risk. Okay? So when you engage in derivative instruments or engage in buying and selling derivative instruments, those derivative instruments are what we call attached or just a result of a particular transaction. So let's give an example. If you purchase item abroad or you are engaged in importation, we know that exchange rate usually fluctuates. Okay? So what you will do is to protect you from the fluctuations of exchange rate, you will enter into another agreement just to make sure that whatever happened with the exchange rate, you are protected. At least any risk that you might encounter will be possibly reduced. Okay? It may not be 100% safe, but at least you are secured on huge amount of loss. But at the same time, there is an opposite on that one. You are not gaining more. Okay? Usually banks engage on this. Okay? So they will anticipate, they will fix the what we call forward rate. Okay? And then company who doesn't want to suffer loss, they will engage in or they will buy hedging instrument or the derivatives. Financial product, a facility through which a person does one or more of the following: makes financial investments, manages financial risk, or makes non-cash payments. Alright. Okay, general regulations of capital raising. The regulatory structure of corporate capital raising relies largely on the importance of disclosure to investors. And that's the importance of presenting a prospectus. Later we will discuss about prospectus. Okay. So when you're trying to raise a capital and you're trying to invite investors, you have to present something to them, right? So because if you don't present something to them, they will not believe you. Okay? So why you're asking us to invest in your company? So provide us with something, at least. Okay? Most of the time, companies will use annual report. Okay? That is actually true. Annual report is a good reference in investing money. But again, as I mentioned to you, when we talk about regulations in raising capital, there are requirements when you want to invite investors. Okay? IPA will have a separate requirements, okay, with regards to this. And if your company is trading their shares in PNGX will require you to provide those informations. Okay? So one of them is annual report. The other one, as I mentioned to you a while ago, prospectus. Okay. Alright, so we will refer our discussion in Corporations Act, which is actually, some of them are applicable here. So we'll go through it. Okay? To be familiar on what these items are referring to. Okay, so we have 4 types of disclosures that will may be used in offering securities to prospective investors. A prospectus, or a short form of that, an offer information statement, and a profile statement. Okay, so you can use either one of these when you're trying to invite investors. Okay, it is obvious if you don't provide information, no one will invest. Okay, not unless maybe you're been friends for a long time, right? Okay, so maybe Helena will invest to who's your friend name? Catherine. Okay, so let's say you want to invest on Catherine's company. So at times you don't really need much information because you have this special bond with each other. But business-wise, you don't do that. Okay, you must have at least information on what's happening with the company, right? Let's see again. This is a reference in Corporations Act of Australia, but again applicable here. We have prospectus. A prospectus for a body's securities must contain all the information that investor and their professional advisors would reasonably required to make an informed assessment. Okay, so just think about what are the things that you want to know when you want to invest in the company. Basically, you will ask, we want financial statements, right? We want to see whether the company is having more assets than liability. Okay, we call it liquidity and solvency, right? That's why some investors will require or may require financial ratio. Okay, maybe you have studied financial ratio in some discussions. Okay, so why do we need to study those? Because some investors may require those ratios, and maybe much better in analyzing a statement with ratios. And others, take note, others may require graph or table, right? Okay, if you've seen an annual report, most likely, especially those studying financial reporting, which you are required to download the financial statements, you will see that the annual report they provided or issued to the public has some graphs. Because some investors may not be good on percentage, but they are good in graphs, okay, tables. Okay, so think of what are the information that the investors or prospective investors will require when you want to raise capital. So those things you have to put into the prospectus. Who are the owners, board of directors, okay, managers? These are the things that the investor also may require. Okay, so you try to cover most of the things that you think they will need. Okay, physical assets, locations, marketing plan, strategic plan. These are the things that may require. Okay, profile statement. A profile statement for an offer may be prepared in addition to the prospectus. If, okay, again, as I mentioned to you, this is Australian reference. Australian Securities and Investment Commission has approved the making of offers of that kind with a profile statement instead of disclosure document. Okay, the next one is an offer information statement. Okay, so this is a body offering to issue securities may use an offer information statement for the offer instead of prospectus, other than a two-part simple corporate bonds prospectus. If the amount of money to be raised by the body by issuing the securities, when added to all amounts previously raised by the body, the related body of the corporate, or an entity controlled by a person who controls the body or an associate of that person. When you talk about body, that's company, or the business. If issuing securities under an offer information statement is $10 million or less. Again, this is just a reference from Corporations Act, okay, of Australia. So you may consider this when you're preparing your offer information. Okay, so what are the documents required? An offer of securities for issue needs disclosed to investors. To understand when disclosure documents are required during the fundraising, it is essential to examine the meaning of the concept of offer and securities. Okay, so the next slide will explain that. Okay, offer. Okay, so it is a widely defined and includes inviting applications for the issue of securities. Okay, so this is what we offer you. Okay, securities that we want to provide. When you talk about security or securities, a share in a body or a debenture of a body. Again, body is the company. A legal or equitable right in shares and debentures, or an option to acquire shares and debentures. So these are the things that may include on the term security. So if you try to offer, these are the securities. Okay? Now, in accounting or in financial reporting, we discuss about application money. Okay, so for management students, when you say when we use this word in accounting, we are talking about share capital. Okay, so share capital, before you issue, someone has to apply for it. Okay, so that we call application money. Okay, the application money received from people applying for securities under the disclosure document must be held in trust until the securities are issued or transferred or the money is returned to the applicant. Now, when someone wants to buy the share of our company, they will need to apply. So that's clear. So what they will do, they will pay what we call application money. So the application money will be kept on what we call trust fund or bank trust, okay, or cash trust. Okay, again, for accounting students, you may be familiar on what I'm referring to. Now, the bank trust or cash trust, we call it, is an account in the bank, of course. But that particular money, you are not supposed, as a company, you're not supposed to use it yet. Okay? Because there are chances that money may be, or the subscribed shares, the number of shares that the applicants wants to buy, may be more than the securities that we can offer. Okay, so clear? So we don't want to use the money yet because we are not what? Giving the securities yet. So which means you have to put it in trust. And then if we had solved who will be investors that will be given shares, then we'll try to sort out whether the application money is equal to the amount or the, let us say, value of the shares that we are issuing. If it is equal, then it's easy. Just give the shares, take the money, put it in your bank account. But if the the application money is more, the value is more than the value of the shares, then you have to return the excess money. Okay? So after that, only on that instance you will be able to transfer the money to your bank account. Okay? So clear? Okay? So hopefully for accounting students, you now appreciate what we're doing in share capital journal entry. Okay, so that's the importance. Now we got it. Okay. Okay. Prospectuses. This is now coming from Companies Act of Papua New Guinea. So this is the one applicable to us. Okay. Okay, prospectuses, form and content. That is under Section 63. Now, with regards to raising capital, you will be able to see it beginning in Section 63. Okay, and then you can see it in succeeding sections. Okay, prospectuses under Section 63, it says, form and content of prospectus. Every prospectus and registered prospectus shall, okay, of course, in writing. That's obvious. Any information that you provide must be always in writing. Okay, but nowadays I don't really see the future that everything will be in writing. Okay, maybe everything will be what? Maybe in a chip. Okay. Okay, but at least maybe the law is telling when you say writing, it should be documented or recorded in a certain let us say, tool. Okay, the tool that we're using now currently is paper. Okay, maybe in the future there will be a different way. Okay, so I'm just telling you the application of the law maybe in the future. Okay, it should be documented, okay, and dated. It is important for us to date the document. The next, specify any documents required by Section 65, later we'll discuss, to be endorsed on or attached to the prospectus or registered prospectus for purposes of this section. Contain all information, statements, certificates, and other matters that is required to contain under this Act. So which means, if you are providing prospectus to your investors or your prospective investors, provide this information which will be mentioned in the Companies Act. Okay, so there will be a requirement. Let's go on to Section 64. Now this one, I'll make it short. It's all about statement in prospectus by expert. So there will be a statement coming from an expert, maybe a financial expert, or maybe if you are engaged in mining, there will be statement about the expert in mining. What else? Actuary. Okay, so these people who are really good on what they're doing or expert, they will provide information. So you can refer to Section 64 with regards to expert. Okay, so this is the one that I'm referring to in Section 65 a while ago. So I think Section 63 a while ago. Okay, requirement relating to prospectuses submitted to registrar for registration. Okay, let's go through it. Every prospectus submitted to the registrar for registration under this Act shall have endorsed on it or attached to it any consent to the issued required by Section 64, so which means if there is an endorsement from expert, from any person as an expert, all documents, information, certificates, and other matters required to be endorsed on it or attached to it for the purposes of this section by regulations made under this Act, and maybe be signed by the issuer of the prospectus and every person who is director or the issuer at the time the prospectus is submitted to the registrar, or by its aid or his agent authorized in writing, and every promoter of securities to which prospectus relates, or by its or his agent authorized in writing. So these are requirements for submission of prospectus to the registrar. Okay. Okay, so registration of prospectus. Okay, the registrar shall register every prospectus submitted to him that complies with this Act. Okay. The registrar must refuse to register a prospectus where, take note of this, it does not comply with this Act, of course. Second, it contains any misdescription or error or any matter that is not clearly legible or is contrary to law, or prescribed amount payable on registration is not paid. Of course, you have to pay the registration. If not, the registrar will not register your prospectus. Okay? And if it includes error or misdescription, and also contrary to the law, the registrar will automatically say, we will not register your prospectus. The registrar shall refuse to register a prospectus where a date of registration would be earlier than the date of prospectus, okay, or he is of the opinion that the prospectus contains a statement that is false or misleading in a material particular, or omits any material particular. Okay. So again, still related to the misdescription or error, if the statements are false and contains material error, the registrar will refuse the registration of the prospectus. Okay, notwithstanding section 2 and 3, as we have gone through a while ago, the registrar shall not refuse to register a prospectus pursuant to either of those subsection where, okay, at the text, diagram, illustration, photographs, and other information, the size and style of the print, and the layout used in the prospectus are, okay, this is section 67, based on section 67 of Securities Act 1997. Okay. He considers that the colors used in the prospectus are such that every word therein is clearly legible, and the registrar may register a prospectus that does not comply with section 65, where he is satisfied that it complies with all provisions of this act, other than section 65, except for those matter referred to, okay, in that section. It is a satisfactory copy of registered prospectus. Upon registration of the prospectus pursuant to this section, the registrar shall forthwith issue a certificate under his hand of that registration, and the certificate shall be conclusive evidence that the prospectus had been registered under this section. Okay, so if all things goes well, registrars issue certificate. That certificate will construed to be an approval or registration of the prospectus. Okay. Okay. Last one for the first part. Okay. We have the second part. Restriction on distribution of prospectuses. Restrictions on distribution of prospectuses with regards to a company. No registered prospectus shall be distributed by or on behalf of an issuer. Okay. After it has been amended, unless all the amendments have been incorporated in every copy of the registered prospectus that is so distributed. So meaning, if there is an amendment, the distribution is restricted, not unless those amendments had already been incorporated with the copies that you are issuing or you will be issuing. And then second, where it is false or misleading in material particular by reason of failing to refer or give proper emphasis to adverse circumstances. So which means again, if there are material error or misleading information, then there should be a restriction on distributing prospectus. Okay? Now, what's the reason of the law mentioning this? It's obvious that we don't want investors to receive false information that will affect how they decide on the investment, on their investment. So, the law is so clear, if that particular prospectus doesn't have the correct information, you are not allowed to distribute it. Okay, so which means, if a company still distributed this prospectus with false information, there will be certain penalties. Okay? Of course, there will be a certain section in Companies Act. They will mention how much the company needs to pay. Okay? Alright, so this is the first part, okay, of our discussion.